Hi, how are you today? How did you find this lesson? Did you have some difficulty understanding the Elliott Wave Theory? You're in good company. The first time I read about the theory, I found it hard to make the heads or the tails of it. So I did a lot of research to truly understand it. The PSEI had been making new highs, and trading has become very interesting. Our topic this week, Elliott Waves and the Cycles of Time, is very relevant. Here, we're going to discuss price movements in more detail as they go in cycles. In this TRT-POV, I will no longer discuss the other items covered by the video, the Conrad wave for copper, commodity, and seasonal cycles. I will just focus on the Elliott Wave Theory and try to simplify it as best as I could. Before we do that, let us do a quick review of the more important things we learned about candlesticks. Welcome to the Responsible Traders POV. These are my notes, my own additional research and studies on the topic that I posted, and my personal observations and opinions that I am sharing with you to further enhance our knowledge and understanding. Some of these were previously posted on the Responsible Trader thread of Stock Market Pilipinas. This is the latest version of previous posts I made. Some of these, plus further explanations and discussions, will be appearing in my forthcoming book, The Responsible Trader. The first thing we have to remember about candlesticks is size. The larger and more solid the candles, the higher the sentiment. Increasing size of green candles show bullish sentiment. In like manner, increasing size of red candles show bearish sentiment. Second thing we have to remember is shape. The shape of the candlestick or pattern determines the type of pattern generated, the possible trading signal, and the potential direction of the trend. Here we have a bullish engulfing, a large green candle engulfing a small red candle in a downtrend. Here we have a bearish engulfing, a large red candle engulfing a small green candle in an uptrend. The third thing we have to remember is location. Location determines what the pattern is called. Here we have single candle patterns, the hammer and the hanging man. Both have the same shape, but their names vary depending on the location. Here we see a hammer in a downtrend. It is a reversal signal. When we see the same shape in an uptrend, it is called a hanging man, a reversal signal. Ideally, in an uptrend, if people keep on buying and do not sell to take profit, price should move along a straight line in an upward direction through time. However, not everything, especially in the stock market, works in ideal conditions. At some point in time, people sell and take profits, and the process goes on and on. I call deviations from the straight line movements distortions. Borrowing from Newton's laws of motion and applying it to trading, for every distortion, there is always an equal and opposite correction. In trading, we also call corrections as retracements. Correction in the stock market comes in two forms, The first is correction in price. The deviation from the straight line, shown by the price movement upward, is immediately corrected by a movement back towards the straight line. Here we have the chart of ISM, where we see this kind of correction. The upward price movement is immediately corrected by a downward price movement. The second form of correction is correction in time. The deviation from the straight line, shown by the price movement upward, is slowly corrected by a sideways movement back towards the straight line. Here you have the chart of the NL, where we see this kind of correction. The upward price movement is slowly corrected by a sideward price movement. If you continue this pattern of upward price movements and correction, we're going to have this figure. Do you recognize the pattern? You're right. This is the basic Elliott Wave pattern, and I have color-coded them here. This is called the 5-3 pattern. The first 5-wave pattern, 1, 2, 3, 4, 5, are called impulse waves. The last 3-wave pattern, A, B, C, are called corrective waves. The first 5-wave patterns, 1, 2, 3, 4, 5, are also called trend waves. Waves 2 and 4 are corrections within the trend. You will notice that even if we have the corrections, we still have higher highs and higher lows. The corrective waves A, B, and C are called counter-trend waves. This represents correction of the trend itself or a change in the uptrend. Whenever I discuss Elliott waves, there are always two names that come to my mind. The first is Ralph Nelson Elliott. Ralph Nelson Elliott was an American accountant and author who developed the wave principle, a form of technical analysis that identifies trends in the financial markets. He proposed that market price unfold in specific patterns, which practitioners today call Elliott waves. By analyzing close to 75 years worth of stock data, Elliott discovered that stock markets, thought to behave in a somewhat chaotic manner, actually didn't. According to him, the market traded in repetitive cycles, which he pointed out were the emotions of investors caused by outside influences or the predominant psychology of the masses at the time. Elliott explained that the upward and downward swings in price caused by the collective psychology always showed up in the same repetitive patterns. He called these upward and downward swings waves. He believes that if you can correctly identify the repeating patterns in prices, you can predict where the price will go or not go next. This is what makes Elliott waves so appealing to traders. It gives them a way to identify precise points where price is most likely to reverse. In other words, Elliott came up with a system that enables traders to catch tops and bottoms. Let us now take a look at all the waves one by one by examining what professional traders or investors and amateur traders are doing at each wave. Henceforth, during the discussion, I will just refer to professional traders, investors as professionals and the amateur traders as amateurs. Wave 1 is the initial takeoff. After a period of consolidation, the stock makes its initial move upwards. This is usually caused by a relatively small number of people, mostly professionals, who think that the price of the stock is cheap, so it's perfect time to buy. This causes the price to rise. The amateurs have little or no participation at all. Wave 2. At this point, professionals who were in the original wave consider the stock overvalued and take profits. This causes the stock to go down. However, the stock will not make it to its previous loss before the stock is considered a bargain again. Wave 3. The strong rally is usually the longest and strongest wave. The stock has caught the attention of the mass public. More people find out about the stock and want to buy it. Professionals who have accumulated the stock during the consolidation stage sell to the amateurs. This causes the stock price to go higher and higher. This wave usually exceeds the high created at the end of wave 1. Wave 4 is profit-taking and buying of dips. Professionals and some amateurs take profits because the stock is considered expensive again. This wave tends to be weak because there are usually more amateurs that are still bullish on the stock and are waiting to buy on the dips. Wave 5 is the point of irrational exuberance. This is the point that most amateurs get on the stock and is mostly driven by hysteria or irrational exuberance. Professionals have already disposed most of their stock and are preparing for the expected change in trend. Most professionals have closed their positions and waiting for the change in trend. Amateurs keep on buying, thinking the stock is going to the stars. Waves A, B, and C signal the beginning of the bear market. Wave A represents the beginning of the new bear market. This is driven by different behavior from professionals and amateurs. Professionals have either exited their positions or short sell in an attempt to establish a position as close to the top. On the other hand, amateurs are buying, thinking that this is just another retracement, another buying opportunity. In wave B, amateurs think this is the beginning of a new rally, only to find out that the expected rally has failed, since the market failed to make a new higher high than wave 5. Wave C represents the massive market sell-off. Most professionals have already sold their positions and have prepared to short sell the market. Amateurs who have bought during waves 4, 5, A or B have suffered potentially devastating losses and price falls sharply to the downside. Panic selling ensues as most stop loss points are hit. As Elliott observed, wave patterns form larger and smaller versions of themselves. This repetition in form means that price activity is fractal. Think of Elliott waves as waves within waves within waves. On this slide, of an ideal complete market cycle, we see waves as fractals, as smaller waves combine to form larger waves. You can see here the waves 1, 2, 3, 4, 5, and then the correction A, B, C, and these waves are composed of smaller waves. So this part is called the motive wave, the impulse waves, and these are the corrective waves. On this slide, we have listed the type of waves, the corresponding labels, and the time frame. The longest wave is the grand supercycle. Elliott speculated this started in 1857, running to the year 1928. However, upon further re-evaluation by A.J. Frost and R. Prechter, start is now considered to be 1789. So we have the supercycle, time frame decades, cycle several years, primary months to couple of years, intermediate week to months, minor weeks, minute days, minuet hours, and subminuet minutes. A grand supercycle is made up of supercycle waves, which is made up of cycle waves, which is made up of primary waves, which is made up of intermediate waves, which is made up of minor waves, which is made up of minute waves, which is made up of minuet waves, which is made up of subminuet waves. Wow, that was a mouthful. The second name that comes to my mind when I talk about Elliott waves is Leonardo Pisano for the Fibonacci retracements. Leonardo Pisano, better known by his nickname Fibonacci, was a great Italian mathematician who lived in the 13th century, who first observed certain ratios of a number series that are regarded as describing the natural proportions of things in the universe, including price data. The ratios arise from the following number series: 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on and so forth. This series of numbers is derived by starting with 1, followed by 2, and then adding 1 plus 2 to get 3, the third number, then adding 2 plus 3 to get 5, the fourth number, and so on. Fibonacci ratios are derived by dividing any number in the series by the next higher number. After 3, the ratio is always 0.625. After 89, it is always 0.618. If you divide any Fibonacci number by the preceding number, after 2, the number is always 1.6, and after 144, the number is always 1.618. This ratio is referred to as the golden mean. Additional ratios were then derived to create ratio sets as follows: 0.236, 0.382, 0.500, 0.618, and 0.764. This set of ratios is used as price retracement levels and is used in trading as possible support and resistance levels. The reason we have this expectation is that traders all over the world are watching these levels and placing buy and sell orders at these levels which become a self-fulfilling expectation. When Elliott wrote about the wave principle, he stated that the Fibonacci sequence was its mathematical basis. Elliott waves, both impulsive and corrective, adhere to specific Fibonacci proportions. Common objective for wave 3 is 1.618. Wave 5 is equal to wave 1. Wave 2 is 0.618 of wave 1, and wave 4 is 0.382 of wave 3. Later proponents of the Elliott Wave Theory came up with so many rules. For our part, we just have to remember the 3 cardinal rules as developed by Ralph Nelson Elliott himself. Rule 1. Wave 2 can never retrace more than 100% of wave 1. Rule number 2. Wave 4 may never end in the price territory of wave 1. And the last, rule number 3. Out of the 3 impulse waves, 1, 3, and 5, wave 3 can never be the shortest. A violation of one or more of these rules implies that the operative wave count is incorrect. In summary, Elliott waves are fractals. Each wave can be split into parts, each of which is a very similar copy of the whole. Mathematicians call this property self-similarity. A trending market moves in a 5-tree wave pattern. The first 5 wave patterns are called impulse waves. These are also called trend waves. The second 3 wave pattern are called corrective waves. Letters are used instead of numbers to track the correction. These are also called counter trend waves. There are 3 rules to be observed when using the Elliott Wave Theory. Rule number 1. Wave 2 can never retrace more than 100% of wave 1. Rule number 2. Wave 4 may never end in the price territory of wave 1. Rule number 3. Out of the 3 impulse waves, 1, 3, and 5, wave 3 can never be the shortest. Okay, this will be all for now. Until then, take care, and I wish you the best in your learning journey, and good luck on all your trades.